investor owns 20 single-family homes in an 8-unit complex in Florida, all rented out. Can we use accelerated depreciation for things like a new roof, AC, kitchen and bathroom remodels? If so, what's the percentage and time frame? All right, so let's break that down. First off, you have 20 single-family homes in an 8-unit complex. You can use accelerated depreciation even if you don't fix them up. If you fix them up, you can use accelerated depreciation, but just remember what it is. You're taking property that is less than 20 years under bonus depreciation and taking it all in year one. So we're breaking the property into those pieces. So let's take a look at the items you just mentioned. New roof, that is longer than 20 years. AC, that is going to be less than 20 years. We can write that off probably under, depending on what type of property it is. We may even be able to 179 that, but we don't really care about that. We're just going to bonus depreciate it. Kitchen and bathroom remodels. Depending on what you're putting into that bathroom and kitchen, yeah, like let's think about this. You spend a whole bunch of money fixing up that kitchen, and inside it there's appliances, inside it there's fixtures and things like that. All of that stuff that's not 27.5-year property. I'm going to be writing that off right away. I'd still do the appliances I do no matter what because they're easy to break out.
Right.
But everything else that's part of it, I'd be breaking out. I'd have somebody do it. What's the percentage and time frame? The average is about 20 to 40% in the first year that you're grabbing and taking as bonus depreciation, which means what's the average? Probably about 20% is less than 27.5-year property. And it's anywhere from 20 to 40%. What's the time frame? We talked about that. You can go back. You can grab depreciation you missed. You can actually do your 3115 election, which is the challenge of accounting method that allows you to do the accelerated depreciation. You could do that, and you can carry it back 2 years. Or you do it the year of and carry it back a year. So, yeah, that's how it is. You can get a huge benefit. We love this. Did you see what that question was?
I did. Diane asked, in 2018, we had a personal rental property held in our own name. We created a new LLC to a disregarded entity since just me and my spouse are on it, but did not get time to quit claim it into the LLC in 2018. It happened in early 2019. So in 2018, all the revenue came to them personally. In 2019, for the first 5 months, it also came to them personally.
It's not going to matter.
Yeah, it's not going to matter because we're going to keep in mind this is disregarded. I'm assuming that it's still disregarded to you.
Yep.
So for tax purposes and even accounting purposes, nothing has changed.
Nope. Everything's going to come down to you. That's actually not the hard one. The hard one.
Oh, they read the wrong one?
I'm horrible. I get fired today.
Diane.
I'm going to fire myself today. I know I highlighted the wrong one, and I gave you the one that's kind of this weird 59AE for $4,800. It's this weird thing on a foreign partner and stuff. So we'll get into that. So Diane, you're good. It's not going to matter. It's flowing under your schedule no matter what. Somebody else asked, is a disregarded subsidiary of a Wyoming holding partnership lends money, would it be considered business income? No. If it's anything that's a loan, it's not business income. And if it's a disregarded subsidiary, they're treated as one entity for tax purposes. You can't loan yourself money. So, Billy, you do not have to do much with that. They're going to be on one return, which, just to give you an idea of how weird it is, you have a disregarded entity. You could have 30 disregarded entities underneath a single LLC, and you still only file the one tax return for the parent LLC, unless that's a disregarded entity to you, in which case it all goes to you. So, kind of cool. Did you see what that question was, Jeff?
Yeah, 59AE, I believe, applies specifically to corporations.
Right. So here's a question. So they have a limited partnership, and they have a GP that is a C corp at 10%. On my K1 for the corp, it shows box 20C, and a statement on the LP return says gross receipts for section 59AE for $4,800. That's probably your 10%, right?
Yeah. But I don't think it's going to apply to them because they're a small corporation.
Right. It's letting you know what portion of that income would be used in that calculation. You do not need to do anything. Why are they doing it? Because they have huge corporations all the time, and they're going to be checking that just to be safe so that that company knows that that's what they're doing.
Yeah, so if you've had a corporation that gets a K-1, this is not necessarily new. There were other codes that only apply to corporations, and there's codes that only apply to nonprofits.
Right.
It's just information they're required to
And Robert responded, the 10% is the $4,800, which means you made about $48,000, and 10% automatically goes under the corporate books. And you don't have to worry about it. Why did I see this on my LP and Corp? It's just because they're checking a box just in case. Hey, but it's 480. Okay, you said he made $4,800. Yeah, it's not going to matter. You should be expensing that thing off pretty easy. Frankly, I'd probably make the whole $4,800 disappear if you have a partnership there. So I'm not going to be too worried about it, but I can see he's saying they're just doing a safety check. You don't have to worry about it. They're just basically, it's almost like the gentleman that had the LP return where it said that this is not qualified business income. All they're doing is letting you know, hey, this is corporate, this is C Corp income that would be used towards this calculation, and you're way underneath the calculation. So I wouldn't worry about it too much unless I'm missing some here. Somebody asked, I'm entangled with a partner, 50% owner on title in an apartment building where I put up 100% of the funds for initial investment and the mortgage is in my name. The partner performs the property management and receives the same monthly cash flow proceeds as I do. How do you suggest I divvy up for tax purposes? Well, if they're receiving a set amount, that's called a guaranteed payment to partner. I would just call that. We're going to have to break this into pieces. If you are in a partnership, then you're going to be hopefully controlled by a partnership agreement. If one partner is entitled to a certain dollar amount, then they would get that as a guaranteed payment no matter what. So if you're paying them a property management, that would reduce the amount of taxable income you then have that's being split up amongst you. If what you're saying is that they're working and their portion, because they're working, they get 1/2 of the income, that's something completely different. Then they are receiving active income, and you would be a passive investor in that. And so they would receive half of the income. You would receive half the income. Their half of the income would be active for for tax purposes. Do you see anything I'm missing on that one?
No, it's really important when we create these partnership agreements that all of this is laid out. Profit and losses, who owns what, because ultimately that partnership agreement is going to determine much of this.
Mm-hmm.